So there we go. If there's at any point you need to mute or something, you can get a copy of this, and that way you can hear what you may have missed. So hello everyone, and thank you so much for joining us for our second webinar to discuss all things real estate. Today our focus is on the R word, and that word is recession. How does a recession affect mortgage interest rates, housing values, and really the big question that I keep asking is, are we in a recession yet? Is it coming? Is it now? So we have a lot of questions around this, and we know a lot of the people we talk to on a regular basis have similar questions. So Janet and I have asked our trusted resource in the mortgage industry, Eric Bibel, and his team, and Nate is also on his team. Hello, Nate, to join us again to break down what it means to be in a recession as it relates to real estate. For those of you who have not met Eric, let me start by telling you that he and his team at Neo Home Loans have helped over 1,000 families with their home financing needs. So with that reach, they are very proud to say that they're in the top 1% of the mortgage originators across the nation. I know Janet and I always count on Eric to have the answers we're looking for. So for everyone, and also, by the way, everyone here, please feel free to add any questions you have in the chat so we can get to those. But Eric, welcome. Thank you again. We so appreciate this time. And Nate as well. And also, why don't you let us know, where would you guys like to start today?
Absolutely. And again, thank you so much for having us here. And thank you everyone that has joined. And I couldn't echo it as much as you said, JoyLynn. We truly appreciate the partnership, the opportunity to work with yourself and your clients. You guys are true professionals and really have a firm finger on the pulse of what's happening in markets. So, being able to collaborate in a setting like this, it is a breath of fresh air. And you said it best, the big R word. Everyone's talking about it. It's in media. It's everywhere that we're turning. And there's a number of questions that are coming from what we're currently experiencing and how that translates into current market context. So what we're designed here, we're going to go through a quick presentation really around what it means, what we're seeing, and then kind of have an open forum and answer questions that you guys have brought around really what we're seeing, what we expect, and where the future brings us from here. So I'm going to go ahead and share this presentation, and we'll kind of get started. So rates, real estate, and recession. Again, the big R word, what's happening, what's going on, and where things are currently going. So first, I want to start by defining ultimately what a recession is. Recession is classically defined as 2 consecutive quarters where we see a contraction in gross domestic product, meaning the output that a nation delivers from goods and services. Second quarter, we recorded a contraction, so a decline in GDP. And based on the fact that we've seen rampant inflation, the fact that cost of goods, services, you name it, has exponentially grown, and we've seen consumer sentiment decline, it is very likely that we're going to see a consecutive quarter of negative gross domestic product. That data is forthcoming. It has not yet been released as we just entered into the third quarter here. So definitely stay tuned as that is forthcoming. But here, one of the biggest things that we want to disseminate and break down is, well, is a recession bad for real estate? Is it not an optimal time to buy? And really what we've cultivated here through this presentation is outlining the historical context around what typically happens in a recession, and then ultimately the byproduct. So current context that we're looking at is Fed hikes lead into recession. We've all heard about Jerome Powell and the Federal Reserve and what they're doing currently to combat inflation, which is through adjusting the monetary policy. Rewind, COVID, economy shut down. That was the most recent recession. The response on behalf of the Fed was to slash monetary funds rate and print an exorbitant amount of money through stimulus. That is ultimately what has led to our inflationary pressures. How the Fed is controlling inflation currently is by what is defined as quantitative tightening. So really what they're doing is restricting the flow of money by increasing the cost to borrow, the cost to acquire capital. And so what I've put together here in this presentation is, if we look back through 1955, as the Fed increases the monetary funds rate, we hit a tipping point and ultimately enter a recession. So the white line is the Fed funds rate. The gray bars indicate recession. So all the way back to 1955, we lead into Fed rate hike, recession. 60, same thing, recession. What happens post-recession, and it's articulated out through the course of history, back as far as 1955, each response from the Fed triggers a recession, but more importantly, post-recession, out of the kind of the rebuilding effort, we see the Fed funds rate decline. And it's shown here in the white line. Why that's important is ultimately that controls short-term money. Now, a lot of misconception around what the Fed controls in regards to mortgage interest rates. They are not intertwined, but typically a leading indicator. So as we've seen this sharp run up as of recent in the Fed funds rate, which is directly dovetailed into the sharp rise that we've experienced in mortgage interest rates. That then brings us to, well, what happens to mortgage rates in response to a recession? We know what happens to the Fed funds rate. They hike, creates recession, they pull back. Basically, they push on the gas, meaning the Federal Reserve, to combat the inflationary pressures or whatever is the catalyst into a recession. They do so by increasing the monetary funds rate, then we see that fall. Same is true for mortgage rates. We again rewind, we went back as far as 1972 here. Again, gray bars indicate recession. The yellow boxes indicate what happens to mortgage rates leading into a recession, and then the response thereafter. 1960, or sorry, that's 1980. My eyes are not as good as they used to be. Into the 1980s, mortgage rates rose at a very rapid manner. On the backside of the recession, they fell. Same in the early 80s again. Fast forward to the 90s, 2000s, 2008. Same in COVID. Mortgage rates rose as soon as the Fed identified, hey, we're in a recessionary period. They pull back the monetary funds rate, enter into what is called quantitative easing. So as opposed to quantitative tightening, the purchasing of mortgage-backed securities to stimulate buying, which in turn increased demand within the secondary markets for mortgages, which in turn drove mortgage interest rates down. Fast forward to today. We've seen an exponentially rise in mortgage interest rates in a very, very short window of time. Rewind, first quarter of 2022, mortgage rates were hovering in the mid threes. Fast forward to today, July of 2022, mortgage rates have broken at 1.6%. We're currently sitting in the high fives. Interest rates have effectively doubled inside a 6-month window. With the fact that we most likely are either in or entering into a recession, that tells me that we should start to see reprieve as kind of all the cards become out on the table, that mortgage rates will respond in a positive manner, meaning come down. The other big component, and something that we get so many questions around, I mean, this is, the growing consensus is, are we in a bubble? Is housing going to decline? Have we seen prices hit a plateau, and are they going to fall off the face of the earth? Well, again, using history again as the best form of intelligently leading into predicting the future, looking back again as far back as 1960, gray bars indicate recession, white line indicates home appreciation. 1960, some interesting things happened. 1970 though, recession. Beginning to end, we saw price appreciation. 1973, price appreciation. 80s, price appreciation. 90s, price appreciation. Dot-com bust, price appreciation. With one exception, 08, we saw price decline. And a key note here is that 08 was the Great Recession was triggered by inflated real estate prices. So the recession was brought on due to basically bogus lending, a glut of supply, a number of other factors. But fast forward to the most recent recession in the pandemic, we saw home prices explode. And here, the leading indicators into the current market context, as opposed to 2008, which again was spurred directly due to the fact that mortgage lending was the Wild West. Anyone that had a pulse could get a loan. And fast forward to today, we have an unprecedentedly low supply of homes for sale, a growing population, and credit guidelines to acquire mortgage are incredibly stricter as opposed to 2008. So here, where this concept that we're going to see prices fall off the face of the earth in, this potential recession or existing recession that we're currently up against, I challenge that belief, and I believe that we're going to continue to see very, very healthy price appreciation through and through what we experience here.
I have a question if I can jump in quickly.
Yeah, go right ahead.
So I think that for some people, and myself included, we keep hearing that the big Great Recession was because the home values were overinflated. And we just saw, I think, close to 10 years of appreciation happen in about 18 months. Is that not overinflated? Or
great question. So, and there's a couple things to unpack there. And I think one, we have to look back to what was occurring in 2008 and what stimulated that activity. So a couple things, we rewind to 08, there was a declining population. So we look at the birthing rates, and historically, first-time home buyers are between the age of 33 and 37 years old. The lead into 08, we actually saw a decline in population. So buyer pool, not as strong as we see today. Secondary component is that we had a massive amount of homes available for sale, both in the resale market as well as the new inventory market. So we had an oversupply issue. So those two components in and of itself, growing supply, decreasing demand, what's going to happen? Layer in the fact that lending standards in 2008 were basically non-existent, as opposed to where they are today. A lender could effectively pick up the phone to call an appraiser and say, hey, this home is being sold for 500,000. Yeah, there's no comps to support it. Well, we need 500,000. So you need to deliver that. So there was a lot of, for lack of better words, shady business that was happening in 2008, which directly correlated to a sharp increase in valuations. Fast forward to today. So polar opposite market. Over the last 4 years, we've had a massive suppression of inventory available, coupled with new inventory. So new construction properties, we're still at a 13-year low of what's being built. So that, coupled with the fact that lending standards through Dodd-Frank, which was the rebuttal to the mortgage crisis, which imposed a gamut of different lending criteria. The lenders can no longer communicate with the appraiser. We can't call value. There's a very, very strict criteria how value is arrived. So now the market has taken over and driven prices up, coupled with low interest rates, low supply, and growing population. So really polar opposites from where we were in 08 to where we are in current context of 2022. But great question, because you look at what we've seen over really, I would say the last 2 years, where we've seen effectively 40% price appreciation. That to me, with no additional context, whoa, this is an overheated market. What is happening? Well, the reality behind that is, well, there's no supply, increasing demand, coupled with incredibly low cost of money. Market's going to allow that frenzy to run in and of its own course.
And then one more question, peak to trough, so that when the rates are going up and then the Fed starts the whole process of easing, how long does it typically take for rates to bottom or hit their low after a recession?
That's a great question. And it really, there's I would say no true methodology behind determining where the bottom becomes, because it's all dependent on a number of factors. One, the lion being how aggressive the Fed intervenes. So rewind, most recent occurrence was that of COVID, where the economy shut down in and of its whole. Fed stepped in a massive way through quantitative easing, where they were purchasing mortgage-backed securities, which spurred so much demand within the mortgage market. We saw rates go from mid to high threes in, what was it, January of 2019, or no, December of 2019, to their lows in August of, what was that, 2021. At one point we saw them touch almost 2.5. So, and that was 100% stirred by Fed's activity. Now, other occurrences where the Fed did not respond in such a sharp, aggressive manner, it usually is a, between 6 and 24 month attrition point where we see an all-out decline of what is defined as true bottom.
I think the challenge is that this impending or current recession and the one before, they're just so abnormal. The reason for them is so outside of the norm that we have all these reasons why the Great Recession happened and this one with COVID. So, this one's pandemic and all the things that came along with the current, and the other one was the mortgage crisis and all the things that you referenced before. So, there's nothing normal about anything that we're going through, this recession or the last one, which makes it very hard for people to put their heads around it and feel secure. So is there something that you can offer to those who are wondering about buying and selling that would give them some peace of mind?
And that is a phenomenal question. And yes, there is so much truth to that statement. Rewind to the most recent recession, COVID, no one saw that coming from a mile away. Same is true for today. I mean, any one event that we would be currently experiencing would be catastrophic in any normal market cycle. The fact that we have hyperinflation, we've got a war between nations abroad, between Russia and Ukraine, supply crisis, the fringe of COVID, those are all in and of itself very, very unique and market drivers in that instance. That said, the predictability around, well, hey, what truly will happen on the flip side of this becomes hard to predict. But what is showing with empirical data behind it is that real estate, despite everything that's happening within other financial sectors, real estate has historically, despite everything that's happened with 2008 considered, has been one of the strongest appreciating assets ever. There is no denying why, but a good chunk of the wealthiest population globally has a large chunk of their portfolio harbored within real estate. So that's one piece. The other piece of it is, in this world, the pendulum, especially in the finance world, the pendulum swings. There is no equilibrium. It's either extreme, not extreme. And we're in this extreme mode where there has been a rapid response that was delayed on behalf of the Fed, why we saw mortgage interest rates climb as fast as they did in an attempt to suppress inflation. It is no doubt in my mind, and growing consensus amongst very, very formidable economists, that this is an overcorrection on their behalf, and we're going to see that pendulum swing in the other direction. So something that Janet and I were talking about earlier was in context of, is now still a good time to buy? Absolutely. I would say that this is the most ideal time to buy, because we rewind to where we were at the beginning of the year, where it was not uncommon to hear 40, 50 offers on a property. And, it was, negotiating your firstborn, blood of your nephew. I mean, you name it. Some crazy things were happening to get the home in your favor. Well, now people are operating in fear, so have decided to put their search on hold. Well, people still need to buy and sell real estate, and we know that inventory is still incredibly suppressed. So with that said, the buyers that were, put on the sideline or beat out multiple times they're over and just, hit a wall and said, we're going to hang this and come back to it later. This could be, or this is the time for them to step in without as much fierce competition to be able to get into a true appreciating asset where we have a finite amount of homes available for sale. So on that, yes, I still believe it is a very, very strong time to buy, and something that is again becoming more glaringly obvious. The rates that we're experiencing within the mortgage sector, these are temporary, and it is now becoming more of a fact that these are temporary based on the actions of our capital markets partners. So the individuals and the entities that purchase mortgage-backed securities within the secondary markets, their pricing behavior with how they interact with mortgage interest rates to lenders, they're showing signs that the mortgages that are originated today will pay off inside the next 12 or less months. And I can get into greater detail with that, but there's a lot of economics behind it. But the way that they're structuring the price delivered to the lender in today's market is empirically showing data that they fully anticipate that those rates will, or those mortgages will pay off inside the next 12 months, which tells me interest rates are coming down. But to that, the fact that we have suppressed inventory, high demand, home appreciation will continue to grow.
So speak to that a little bit, Eric, in terms of the rates. And, I think there's just, like you mentioned, a fear overall. So people tend to want to time the market. And so they're thinking, and we get a lot of questions about this, if you are saying that the rates are going to come down, why should we do this right now? Because the prices are crazy and the rates are going to come down. Let's just wait. So
that's a great question. So on that one, I do not believe we're going to see price decline. So that is a very, very strong separation. I think the home that is priced today will continue to see healthy price appreciation for the next 5, 7, 10 years. So here, if you're of the mindset of, well, hey, I'm just going to pause and wait for rates to come down. Well, perfect. Your rate will come down, but that same home is going to appreciate year over year. So effectively your payment will remain equal. And again, that comes back to the fact that there's suppressed inventory. I mean, we're down in some markets over 75% year over year. And last year was a suppressed inventory market. So here, this, concept of I'm going to, kind of sit on the sidelines and wait. Yeah, your rate will come down, but the home price will go up. So ultimately you're going to be met with an equal or possibly even higher payment, depending upon how much more values increase.
And I think what people have to understand too is that sellers have fear also. And right now, because things are shifting, I think there's opportunity for buyers because there's that fear, and there are sellers that always have to sell. They have a reason to move. And we're seeing more listings come on the market, yes. But just as a side note, we're not anywhere near, we're getting closer, but we're not at the levels of 2020 yet in terms of inventory. And that was 2020 when things were really low still. So I think there is opportunity though, because as sellers are saying, they're hearing all of this, oh my gosh, there's more listings, we're seeing price drops, I need to sell. That's where the buyers can capitalize on that emotion.
Definitely. It's truer words have not been spoken there. But that, again, the key component there is we hear price drop. Well, there's a crash coming. No, that's the piece of the puzzle that we really want to hammer down here, is that what we experienced over the last 2 years, again, 40% appreciation in San Diego alone, was spurred by, I would almost call it FOMO buying. We had incredibly cheap money. I mean, some of the cheapest money we have ever seen in our lifetime, likely we'll never see again, coupled with historically low inventory and this frenzy, especially here in San Diego market. We were absorbing so many employers and employees that were relocating because of the work from home policy. So this run up in values that we saw over the last 2 years was driven by the fact that money was so cheap and that people were now in a position to relocate to anywhere they wanted to in the country. And San Diego was the ultimate byproduct and the benefactor of that. So here, this rampant rise in values, we knew that that was not sustainable. Year over year, 20% appreciation or double-digit appreciation, no market can sustain that. Historic appreciation nationally is anywhere between 4 and 6%. So if we go from, what was happening as recent as March of 2020 or 2022 to where we are now, even if we see prices correct 10%, which again, I don't believe will happen, but if we did see that, we would still have an aggregate of appreciation numbers north of 30, which is phenomenal. And here, knowing the fact that we don't have any other places to build, especially here in San Diego County, we don't have a plethora of new construction happening. we live in one of the most desired counties for areas in the country. Unless we go and join Hawaii, which, we fall off the side of the California, we're still going to be a very, very desired area, which in turn drives to price appreciation through and through.
Eric, do you have a way of demonstrating to the consumer when they're considering purchasing a loan, the cost of waiting, meaning the
Absolutely.
lack of appreciation and the savings on their mortgage interest deduction?
Absolutely. We can do individual scenarios. It takes a little bit of time to build up, so I couldn't just do it here on the fly, but I could definitely put something together as kind of a general concept, but really looking at, especially through the appreciation numbers and quantifiable tax benefit within homeownership. We're talking tens of thousands of dollars. And over the life of the loan, it's in the hundreds of what that kind of hold period entails.
But even just waiting a year, if we're looking at, for simple numbers, $1 million property and a conservative number of 3% appreciation, that's $30,000 right there. Not to mention the benefit, the tax benefit of
Exactly. We could be talking, just in that scenario alone, 1 year of waiting, $52,000 in savings, not to mention, if that individual is currently renting, that money that you're putting each month into rent is, it's providing shelter, but other than shelter, there is no safe harbor within your tax portfolio, principal reduction, so for savings through repayment of the financing. There's so many other components too that have to be taken into consideration.
So what was that catchphrase, Eric? Marry the home,
date the rate. The home is the forever piece. The interest rate is interchangeable. And that goes back to the point of, potential sellers that may be sitting in an interest rate that is, has a 2 handle or 3 handle in front of it. Well, those interest rates, highly likely, those interest rates were refinance mortgages. They were not acquisition loans. Person that acquired the property likely had a rate in the 4s or 5s if you go back 2018, 2017. So here that the loan can always be restructured. There is no prepayment penalty on any of our products, but the home can never be replaced. The home is the home. That is it. So here, this concept of, okay, well, I'm going to jump into the home now, capture the appreciation, allow the tax benefits to roll, and as rates temper or taper, look at an opportunity to restructure the debt at a lower time like we did in 2020 and 2021.
So one more question, then I don't know if there are questions from the people participating or not, but I do know that a couple of us on here are real estate investors. Talk to us about what is happening for real estate investors and rates, because there's been a big change.
Big change, massive change within that space, and really depending upon, so first and foremost, I still believe real estate is a very, very strong investment, even with kind of the tightening of credit guidelines within those parameters. So here, if there's opportunity to strike, now is definitely still a phenomenal time. But as far as the ability to acquire capital, depending upon how the loan is structured, there's definitely been some changes within the qualified mortgage space, and more importantly, the non-qualified mortgage space. So when I define non-qualified, we're looking at typically debt service loans that looked at the asset as opposed to the borrower. That space right now, when we start to see a hyperinflation area, recession pending, that investor sector, because it is non-federally backed money, it's private money that's investing, they get spooked. Because there's fear that, hey, if you've got an 8 handle in front of your rate, well, if investment property, that's the first that gets defaulted on if the individual loses a job. So that space has wildly constricted, and we've seen guidelines literally change overnight. So there, if you're looking at non-traditional money, there's definitely been some changes, I would say, over the last as soon as this week alone. Inside the traditional mortgage space, with the kind of inclusion now of Airbnb, a lot of people were purchasing homes as second homes and then renting on Airbnb. For a long period of time, the agencies, Fannie Mae and Freddie Mac, were pricing second homes the same as primary residence, but they weren't factoring in the risk element of it being an investment property. So with that, we've seen inside second home pricing, and more importantly, investment pricing inside the agency structure, those rates have gone up as well. There's additional costs, and it all comes down to risk protection on behalf of the lender itself.
And do you mind just sharing where you are with the investment rates right now? I'm just curious, based on a 25% down.
Great question. We actually just locked one yesterday in Arizona. Purchase price was $425, 25% down, mind you, top tier credit, so 760 or higher. We were 6.375 for no points.
Okay.
And for context, primary residence, if that were a primary residence, same parameters, top tier credit, 25% down, interest rate in that would be 5.5.
Okay, so not as bad as we're hearing out there in the press.
No, and that's, you know, we definitely want to make a clear distinction. That is agency money. So your traditional Fannie Mae, Freddie Mac, your Manila conventional loan. When we start looking at alternative financing options, especially within the investor sector, so I would almost define it as private money, that is where we've seen rates just kind of almost be like hard money solutions. I've heard anywhere between 7.5 up to 9.5. It just really depends upon the type of loan, the loan amount, the down payment, the service against the property, so on and so forth.
The 25% down is in order to get something like that, you got to go 25. You can't go
25 is right now kind of tickets to the game. That is really the sweet spot in pricing. There are options that allow for, in some instances, as little as 15, but their, rates are not going to be as favorable. You're going to carry mortgage insurance. So, the premise around investment properties is cash flow. When we start layering other aspects within the payment, we definitely impact cash flow. So it becomes almost counterintuitive.
Is that the same? You mentioned that was for single family. Is that the same for larger?
Correct. Now, when we start looking at multi-units, it really depends upon the price point. There could be requirements, a 3-unit will typically require 30% down, 4-unit, 35. When we start looking at multi, so inside the commercial space, it could be anywhere between 25 and 50%, depending upon the loan amount, purchase price, and what have you.
Anything else we need to cover? I just wanted to give everybody an opportunity to wrap up, ask any last minute questions. So long story short, we're probably in a recession, but we won't know for sure until the end of this quarter, which is not too far away.
Correct.
And there isn't any real solid data to tell us when we will see the lower rates again, but it could be as long as 24 months, typically or historically.
And here, we and great point, and I'll kind of tie it down with this. I firmly believe we're in a recession. There are so many telltale signs. Jobs report came out today, beat expectations, but we're hearing and seeing a growing number of initial jobless claims hitting the market. So people that are exiting employment, seeking benefit from the federal government. That's leading indicator number one of a recession. Coupled with the fact that the Fed has put their foot all the way on the gas to temper or taper inflation as of itself. So the cost of money has risen exponentially fast. And the fact that we look at goods and services, in some sectors up over 200% from where we were last year. So money is pouring outside of the economy, which is naturally going to slow things down. And now this recession, which again, it's not if, it's when, is induced on behalf of the Fed reacting to their monetary shift on the fringe of COVID. So here, I do firmly believe that when this does bear fruit and show full signs of recessionary indicators, you're going to see the Fed take a sharp correction and move the pendulum in a different direction, which in turn is going to drive rates down, cost to borrow is going to lower, and we're going to still continue to see very strong price appreciation. So, yes, it feels uncomfortable right now. Yes, it's uncertain, but I do see a very, very strong light at the end of this tunnel.
Wonderful. Well, we thank you again very much. Janet,
I got
is
one
there
more
anything
if you
else
don't
wanted-
mind.
Oh, no,
Yeah,
please.
shoot, please.
I read in the Wall Street Journal yesterday, it said, so the Fed is raising rates, but interest rates, mortgage rates actually came down. How does that work?
It's a great question. So quick backstop. Fed only controls short-term cost of money. So they really, when they adjust the Fed funds rate, it's what banks charge one another to move money overnight. You see an impact on your home equity lines of credit, credit cards, car loans, student loans, short-term debt. The bond market is what controls mortgage interest rates. What we're seeing right now, the behaviors from the Fed are to taper inflation. Inflation is the arch nemesis of long-term yields, which are mortgage debt. So here in this kind of paradigm that we're experiencing right now, the Fed is doing everything that they humanly can to drive inflation down. Stock market's tumbling. So bonds become a safe haven for investors. Bonds again control mortgage interest rates. This activity pulls money from one sector of the market out of the treasury notes, out of the stock market, and pours into the bond market, which spurs demand, which drives mortgage interest rates down. We're definitely inside a very unique paradigm where historically when the Fed is jacking up rates, we're seeing quantitative tightening, mortgage rates rise with it. Well, in this instance, we're actually seeing kind of the opposite behavior because it's showing bond traders that, oh, Big Daddy Fed is very serious about tapering inflation. Okay, let's pour in over here. So over really the last 2 weeks, we saw almost a 236 basis point improvement, which is about a 0.75% improvement to mortgage interest rates itself, despite all the economic data that was coming out dim and in gray and the stock market underperforming as well. So unique paradigm. In a normal market, that would be true. We would see as the Fed rose, we would see mortgage rates rise, not in parallel, but typically as a leading indicator to mortgage interest rates rising.
And
Great
I think
question.
you mentioned to me before, Eric, that just with the Feds announcing that they're going to raise rates, mortgage interest rates at that time a couple of weeks ago just shot up just with that announcement. So they're kind of building in some insurance for themselves. Is that right?
Yes, and there's the mortgage activity, so bond activity that we're seeing. Before the Fed actually announces, hey, we're raising the benchmark rate by X amount, 50 basis points, 75, whatever it is, that's already been priced into the market because the Fed has been very direct in saying, here's what we're doing and when we're doing it. So it's not Fed raises today, mortgage interest rates rise 0.75% tomorrow. The market has already responded to it. And here with this activity, the fact that the Fed is really pouring everything they can into addressing the inflationary pressure, as inflation comes down, we will see mortgage rates come down with it. The economy cannot sustain with mortgage rates in the sixes. They can't. It is unequivocally, it will put the economy on lifeline. And more importantly, the Fed does not want short-term debt as high. That creates interest payments on debt borrowed exorbitantly high. No one wants to see default, especially at the United States level. I mean, that would be catastrophic for everyone. So it's kind of a yin and yang at this moment. They're wanting to taper inflation, but also wanting to lower the cost of money. So I see swift action, but I see swift correction in the same breath.
Awesome. So I know a lot of this was economic speak, and sometimes I have to say it goes over my head, so I have to reel Eric in and say, okay, Eric, what are these terms here? And, I just want to say that that's why we're here to be a resource. We collaborate on a regular basis and we pull our sources together. So we are absolutely here, phone calls away if anyone needs, market analysis or just kind of look at your individual situation.
Yes, likewise. Anything that I can do to help. I mean, this is, you could say it lights me up. This is, I would define as my genius zone. I absolutely love what I do. And, any questions that are out there, as Janet mentioned, we collaborate constantly. So if there's anything that we can assist with, we're all ears and all hands. So we just appreciate it.
Thank you so much.
Thank
Thank
you.
you, Eric. Thank you, Nate, and for everybody that joined us. We
Thank you all.
appreciate you. And this will be recorded. Let us know if you would like a copy of the recording, and we'll do this again next month. We don't know the topic yet. If you have something that you would like to suggest, we are all ears. And we just thank everybody for spending this time with us.
Likewise. Thank you
Have a
all.
great day.
Everyone have a wonderful day. Enjoy the weekend. Okay.
Bye-bye.
Bye-bye now.